Hi there, I'm Tara from Money Management International, a full-service nonprofit credit counseling organization. When the price of consumer goods rises quickly, the Federal Reserve may increase the federal funds rate to help reduce this inflation. The federal funds rate is the interest rate banks pay when borrowing from and loaning money to one another. It's determined by the Federal Reserve, and they adjust it to help manage the economy. In fact, according to Forbes.com, the federal funds rate has ranged from 20% in 1980 in response to extreme inflation, all the way to zero in 2008 and again in 2020 in response to the COVID-19 pandemic. A higher federal funds rate means banks pay more to borrow money, and they pass that cost on to their customers in the form of higher interest rates. When borrowing is more expensive, there's less money flowing through the economy, which can help reduce inflation. On the other hand, a lower federal funds rate makes borrowing more affordable, working to stimulate the economy by increasing the amount of money flowing through it. So the federal funds rate is important because it helps maintain a stable economy and it influences consumer interest rates on things like credit cards and loans, and also on savings accounts. And the stock market tends to react to adjusting rates too, performing better with rate decreases and dropping with rate increases historically. To better understand what rising rates mean for your money, let's start by looking at the prime rate. The prime rate, which banks charge very creditworthy borrowers, like big corporations, is generally set at the federal funds rate plus 3%. Meaning that a federal funds rate of 3.08% would set the prime rate around 6 to 6.25%. When the prime rate goes up, rates on consumer lending products go up too. You'll pay more for credit cards, automobile loans, mortgages, and other loans. The idea is when it's more expensive to borrow money, consumers will borrow and spend less, decreasing demand and lowering the price of everyday goods, which would all work to help reduce inflation and stabilize the economy. The risk is that higher interest rates and high inflation, combined with slower growth, could lead to a decline in economic activity or a recession instead. And ongoing issues like supply chain constraints and wars also impact the global economy. So the Federal Reserve acts carefully, and the end result will depend on several factors. So, when rates are on the rise, take steps to help safeguard your finances. First, assess your situation and revise your monthly spending plan. Then analyze and reduce your debt. There are several ways to do this, and if you need help, reach out to a trusted organization like MMI to discuss your options. Be patient when it comes to making large purchases. It may be best to wait if you can, and if you do take out a loan, be sure to shop around for the best deal. Continue to save regularly, even increasing your savings if possible, to help ensure you have enough set aside to handle a financial setback. And keep in mind, what goes up must come down. Interest rates will change, but higher rates could benefit you in the form of higher returns on savings and investments. For traditional savings accounts, for example, you may yield a better return with online banks, so shop around and compare to find the best one for you. If you have long-term investments, don't panic. They'll likely weather economic storms, so stay invested and consider making periodic investments instead of making swift changes based on predictions or waiting for the best time to invest. If you have a financial advisor, talk with them about the best options for your situation. And if you have additional money to save or invest, consider savings bonds issued by the federal government. Specifically, Series I savings bonds carry a fixed rate of interest plus a rate that changes with inflation, making it an attractive option even in a changing economy. Every 6 months, interest is applied to the new principal value, and unless it's cashed out, a Series I savings bond will earn interest for 30 years. So this can be a good way to add diversity to your portfolio, especially as interest rates are on the rise. Electronic bonds are available at a minimum of $25, and you can buy up to $10,000 each year. To learn more about Series I savings bonds, including current rates and buying options, visit treasurydirect.gov. Fluctuating interest rates are common in our economic landscape. Being aware of changes and how they affect you and taking steps to safeguard your finances are important parts of building a strong financial plan. To learn more about this and other financial topics, or to schedule a counseling session, call 866-889-9347 or visit us online at moneymanagement.org today.